Well, for more on this, we're joined by economist Brad Olson from Infometrics. Kia ora, Brad. Thanks very much for coming on with us. Interest rate rises always hurt, but did the Reserve Bank have any choice today?
Not really. We know that inflation is still considerably too high. The Reserve Bank wants to see it at 1 to 3% per annum. It's currently at 7.2%. And importantly, it has plateaued in more recent times, but we're still not seeing it start to actually pull back into that more achievable range. And for the Reserve Bank, when they've looked through the numbers, they're still worried that when you look at economic pressures, there's still a lot going on. Economic demand is still outstripping just how much supply we have, and to try and bring down the temperature of the economy, they're needing to push those interest rates up further. Importantly, although they've made a 50 basis point increase today, they're also still expecting that there's perhaps another 325 basis point increases throughout the next few months to try and really knock the top off inflation and get things back into a more manageable range for Kiwi households.
Okay, well, speaking of manageable ranges, what is going to happen to mortgage repayments and people's ability to pay them?
Well, we know that a lot of people are yet to even refix onto the higher mortgage rates that we've seen advertised over the last few months. In fact, around about half of the mortgages by value across the country are due to refix at some point this year. And realistically, the increases that we saw announced today and those future increases that will be coming through from the Reserve Bank will be lifting those retail mortgage repayments that some households will be having to pay. We know from recent affordability data that there are a lot of people spending half of their average household incomes just to sort out their mortgage repayments. That is going to be difficult, but we know that realistically, to get inflation under control, we've got to see people spend effectively more on their mortgage so they can spend less on other things, and to help cool the general sense in the economy just a bit.
Okay, just very quickly, all of this comes as people are going to have to spend more money on all those items lost in the cyclone, everything from roads to housing to food. That's all going to go up and be inflationary, isn't it? So how does that fit in?
It's a difficult balance for the Reserve Bank. Realistically, there is going to be some inflationary pressure from the cyclone coming through. The Reserve Bank will want to, and has been looking through that and is looking more to the medium term. Realistically, the Reserve Bank has a sledgehammer here. It's a very blunt instrument with interest rates, and they still have to focus on just how high and intense and persistent inflation still is. The cyclone recovery will have to be assisted by government. That fiscal response being a much more targeted surgical approach to what the events that we've seen come through the country in recent weeks.
Brad, thanks so much as always.